village, they provide certain benefits, they provide education to underprivileged people, they take up some social welfare activities, they look at the benefits of the society at large and take up certain things. From the accounting sense, some of the organizations do come in, provide tax returns facility free of cost. Some of them educate, some free classes are conducted to provide some education in terms of technology or something, some courses that are offered to underprivileged sections of the societies for the benefit of them. At schools and colleges, they organize certain campaigns for some kind of benefit. So those kind of um, activities are taken up. They themselves feel the responsibility. What what ought to be done by the government? If the government does not do it, these corporates do, they take that moral responsibility, and provide benefit to these different stakeholders. That's chapter 9 about corporate social responsibility. We defined what is the nature, definition and nature of CSR, the stakeholder theory given by Menlo, what should be the strategy that has to be adopted in terms of dealing with the stakeholders. Now we still have not done principle-based approach of corporate governance. We're still looking into, just learned about what is rule-based approach of corporate governance. After that, we have discussed certain other aspects about CSR. Now we need to learn about what is effective leadership. Okay, this is a very general topic about leadership. There are certain models about leadership that are given. After that, we will come into principle-based approach. Okay, leadership topic is a very general thing, so I will not spend a lot of time on dealing with the leadership section as such. So, who's a leader? Someone who leads, is called as a leader. So, definition of what is definition of leadership? Leadership is an interpersonal influence directed towards the achievement of a goal or goals. Interpersonal means between persons. So there is an interpersonal influence between people, between persons. There is influence, interpersonal influence. It's the power to affect others to achieve the goal or goals. The goal is the end one strives to attain. Leadership can be viewed from three standpoints. One is an attribute or a position, a characteristic of a person, whether he's a natural leader or not, a category of behavior. There are different theories, models that are explained about leadership styles. Okay. First set of it is about trait theories, behavioral style theories, contingency contextual theories. Okay, then we see the difference between leadership and management, leadership and culture. If I'm not wrong, if you have done this in first foundation level papers, F1, accountant and business, do you remember doing this? Somebody respond. Do you remember doing this in accountant and business? Different leadership theories, leadership, the concept of leadership, mentoring. At least somebody say yes, no. No is also an answer. You didn't do accountant in business, the paper? That's in the old syllabus. The new one is business and technology. BT. F1. What is the title of F1 paper? F1. No one knows what is F1? Okay, leave the title. Did you learn leadership theories? Did you learn leadership theories? Is my question so difficult to answer? In a class of 100 plus students, not even one answers. So painful. You answer and I'll continue. Let me also wait for some time. Very nice answer. Don't remember. Semester 1, what did you learn? Okay, why waste time? Let's proceed further. See, the next chapter, chapter number 10 is effective leadership. Effective leadership. We understand the nature of leadership, then we understand different types of leadership, entry, and intrapreneurship. Entrepreneurship and intrapreneurship. Simple terms, who's a leader? Someone who can lead. Leadership is there are different aspects. It is a relationship between persons and having an influence on them to achieve the end objective. So that's about leadership. See, there are different types of leaderships. First one is it's trait theories. So trait is an attribute, it's a characteristic, it's a feature. So based on that trait theory, so great leaders were considered to have, for example, these traits. What are those traits? Physical traits, like someone who's with a well-built structure is looked at as a leader. So such as drive, energy, appearance, height, etc. Personality traits such as adaptability, enthusiasm, and self-confidence. If they possess these things, they can be they are treated as leaders. Social traits such as cooperation, tact, courtesy, administrative ability. Then we see above average intelligence. That could be another trait. Initiative, proactiveness, that is independence and inventiveness, and the capacity to perceive need for action. If they are motivated, self-motivated, motivate others, that's another trait. Self-assurance and self-confidence. The helicopter factor, the ability to rise above the particulars of a situation and perceive it in relation to the surrounding context. So they find that there is a need to take an action in that particular situation and respond to that situation. Then certain other essential qualities like enthusiasm, sociability, integrity, courage, imagination, determination, energy, faith, and virility. See, when these characteristics are found in people, we see these attributes. They are called as leaders. So this is based on traits theory. It's not that all of them, all these traits should be found in leaders. It could be one or combination of any of these traits that makes them a leader. Traits theory. Next is behavioral style theories based on the behavioral. Um, First, when a successful leader will exhibit a pattern of behavior, the first one is um, a leader who tells autocratic. Someone who dictates, tells autocratic style of leader. Okay. Somebody who sells is who convinces them, persuades them, persuasive. Third type of leadership style is the one who consults, approaches them for the opinion of the other party, consults or participative. Fourth one is democratic style, where they all work together, join hands with the others to get the work done. These are the four different behavioral style um, attributes which are exhibited in the leader. Someone who tells autocratic, okay, dictatorship, what we can call it as, persuasive, convinces in a pleasant manner, convincing, persuasive attribute. Somebody who consults for the other's opinion. Last one, democratic style. It's a free environment where all of them work together to achieve the end objective. Then we see contingency contextual theories. Contingency contextual theories. Style theories ignore the most influence of the context in which the leader is operating. So what are style theories? Someone who tells, sells, consults, and joins. So style theories ignore the important influence of the context in which the leader is operating. So the situation, the context is again important. So focusing on the context, contextual or contingency theory. There is no one best style of leadership that is equally effective for all circumstances. We don't have a standardized pattern. So the leadership has to adapt itself according to the given situation or to the context. Just having certain attributes is not sufficient. Just have able to follow a style of working, either dictate them or convince them, persuade them, join hands with them, approach them with their for their opinion, etc. So these things are just style of operation. It says that style does not consider about the situation. Sometimes when it is required to be strict, okay, to get work done, it has to adopt to that particular situation or context. There is no one best style of leadership that is equally effective for all circumstances. So a mixture of traits and contingency is the situational approach. That is, example, economic depression, Hitler in Germany of 1930. So the situation was there was a depression in Germany, and Hitler adopted an autocratic style. He just commanded, he wanted things to be done in a particular manner. So that resulted in a situational approach. So if they have to overcome, if they have to capture many other countries, and then Hitler had his own strategy. See, he didn't have the physical traits. He was not called a leader based on the physical traits about the height, appearance, etc. Those things were not there. He just had a situation which was economic depression, and then his style of leadership was autocratic. So that's about contingency contextual theories. Then we see leadership and management. Understand what is the difference between that. Management, the process of setting and achieving the goals of the organization. Management says it's the process of setting and achieving the goals of the organization. Leadership deals with the interpersonal aspects of manager's job, whereas planning, organizing, and controlling deal with the administrative aspects. How do we differentiate between leadership and management? Employees willingly follow leaders because they want to, not because they have to. Therefore, a leader can be a manager, but a manager, someone who manages the affairs, leader, someone who leads them. So, but a manager is not necessarily a leader. Leader can be a manager. Manager not necessarily is a leader. There are two types of leaders, leadership and culture. First one is transactional leaders. Transactional leaders tend to be more passive. They see their relationship with their followers in terms of a trade. But transformational are more proactive. So different types of leaders, someone who's passive, someone who's proactive. Okay. Proactive leaders are called as transformational leaders. Passive leaders are called as transactional leaders. Okay. They see their relationship with their followers in terms of a trade, but the ones who are proactive, they see their role as inspiring and motivating others to work at levels beyond mere compliance. Let's just discuss about entry and entrepreneurship. An entrepreneur is a individual that starts up a business. He's the owner and takes all of the risk of financial loss. But entrepreneur is an employee of the company and does not usually have any ownership and minimum risk of financial loss. Just learn the difference between these two. Now we come to principle based corporate governance, the concept of principle based corporate governance. So, in this context, we have to look at the board of directors. Okay, the board of directors, what are their roles and responsibilities? There is a structure of the board of directors in which there are executive directors, non-executive directors, unitary versus two-tier structure. Then the different committees that are appointed by them, we see that the composition of different committees and what is the role of these committees. See, in today's class, we have started with the approaches to corporate governance. First one is rule-based, which is followed in US, but in the UK, it is principle-based. So how does it happen? What's principle-based corporate governance? So there are certain principles that are set internally for them to follow. So the UK Corporate Governance Code 2016 provides certain principles which have to be followed. First one is provide entrepreneurial leadership of the company. Once again, the concept of agency theory talks about there is a company. We see there are shareholders, and then we see there is management. When there is a company established with the funds of the shareholders, who would run the affairs of the company? The top management, or we see the board of directors run the affairs of the company. But basically, they have a responsibility towards the shareholders to maximize their profitability. That's the concept of corporate governance, or rather agency theory. So how do they manage the affairs of the company? That's the concept of governance, the system by which the companies are controlled and directed is corporate governance. So in the UK has UK Corporate Governance Code. According to the UK Corporate Governance Code, or the principle based corporate governance, we see that this code provides entrepreneurial leadership of the company. They represent company view and account to the public. They decide on a formal schedule of matters to be reserved for board decision. Determine the company's mission and the purpose. Select and appoint the CEO, the chairman, and other board members. This has to be selected. Select and appoint. Set the company's values and standards. As per the principle-based approach of corporate governance, there are certain roles and responsibilities. Provide entrepreneurial leadership of the company, represent company and company's view and account to the public. They have that responsibility on them. Decide on a formal schedule of the matters that have to be discussed in the board meetings. Decide what is the company's basic mission and purpose. Selection of CEO, chairman, and other board members. And select the company's values and standards. Those are the roles and responsibilities. To be continued, ensure that the company's management is performing its job correctly, so that there is no agency problem arising in future. Establish appropriate internal controls that enable risk to be assessed and managed. Then ensure that necessary financial human resources are in place. Ensure that its obligations to its shareholders and other stakeholders are understood and met, and meet regularly to discharge its duties effectively. Then, as part of their roles and responsibilities, they are to appoint, for a listed company, they are to appoint non-executive directors. So there are different committees that they have to establish. Remuneration committee, nominations committee, audit committee, assess its own performance and report it annually to shareholders, submit themselves for re-election at regular intervals, and the potential problems are rely on management to report information. So what we'll do is we'll just take up one small case study. This is very general. It is based on this only. So as we discuss that, then we will be able to understand this board structure rather clearly. So if the board has a, see if it is a unitary board, there are executive directors, there are non-executive directors. If there are two tier boards, there should be one management board and one supervisory board. Okay. I'll put the content. See, all this we will be able to discuss along with that particular case study. As it is from the beginning of the session, class is going on a very dry note. I'm putting in this one case study I'm sharing on the screen as part of governance. All of you please follow, not a very big one, very small case study. It is about corporate governance only. It says that write a report to Timothy Roche criticizing the governance arrangements of Roche and Company and assessing the usefulness of a nominations committee. So we will refer to nominations committee first, but let's first refer to read through the content given in the case study. Will someone read the content there on the screen? Anyone interested to read the content? Anyone interested to read it, which is there on the screen? Anyone interested to read the case? Follow, I will only read. The question says, Mary hopes the board of Roche and Company, a large retailer, as finance director earlier this year, while she was glad to finally have been given the chance to become a finance director after several years as a financial accountant. She also quickly realized that the new appointment would offer her a lot of challenges. In the first board meeting, she realized that not only was she the only woman, but she was also the youngest by many years. Roche was established about 100 years ago. Members of the Roche family have occupied senior board positions since the outset, and even after the company's flotation 20 years ago, a member of the Roche family has either been executive chairman or chief executive. The current long-standing chairman, Timothy Roche, has already prepared his slightly younger brother, Jeffrey, Also long-standing member of the board, to succeed him in 2 years' time when he plans to retire. The Roche family, who still owns 40% of the shares, consider it their right to occupy the most senior positions in the company, so have never been very active in external recruitment. They only appointed Mary because they felt they needed a qualified accountant on the board to deal with changes in international financial reporting standards. Several former executive members have been recruited as non executives immediately after they retired from full time service. A recent death, however, has reduced the number of non executive directors to two. These sit alongside an executive board of seven that, apart from Mary, have all been in post for over 10 years. Mary noted that board meetings very rarely contain any significant discussion of strategy and never involve any debate or disagreement. When she asked why this was, she was told that the directors had all known each other for so long that they knew how each other thought. All of the other directors came from similar backgrounds, she was told, and had worked the company for so long that they all knew what was best for the company in any given situation. Mary observed that notes on strategy were not presented at board meetings, and she asked Timothy Roche whether the existing board was fully equipped to formulate strategy in the changing world of retailing and whether a nominations committee would help address weaknesses. She did not receive a reply. Timothy Roche had subsequently approached you, an external consultant, to see if there are any weaknesses in the current governance structure of Roshan Company. He also wanted your views on the role and usefulness of a nominations committee. Write a report to Timothy Roche criticizing the governance arrangements of Roche and Company and assessing the usefulness of a nominations committee. There is a small situation given. It's about a person called as Mary Hopes. She joined the board of this company, Roche and Company. She was glad to have finally been given the chance to become a finance director of several years. So she was associated with the organization in the capacity of a financial accountant. Please follow this case study. So from this role of financial accountant, now she has become the finance director of a Roshan Company. In the first board meeting, she realized that she was the youngest among the board members. Others were there for a very long time. She was the youngest by many years in that board. She also became a financial director, a member of the board of directors. Others were all much senior to her. One second. Sorry about that. So she realized that she was the youngest in that board among the directors. Roche was established almost 100 years ago. Members of the Roche family. So members of the Roche family over this 100 years time period, members of the Roche family have occupied senior board positions since the outset and even after the company's flotation 20 years ago. A member of the Roche family has either been executive chairman or chief executive, CEO or the chairman of the company. It was from the Roche family only. So right from the time of inception, even after the company's flotation, that is 20 years back also, so someone from the Roche family only was taking the that crucial position, either to become a chief executive or to become the executive chairman. See, this is what Mary Hobbs has observed. The current long-standing chairman is Timothy Roche, has already prepared his slightly younger brother. So, who would succeed him after he retires from the chairman position? The present chairman is Timothy Roche. After him, it will be his brother, Jeffrey. Also, long-standing member of the board to succeed him in 2 years when he plans to retire. The Roche family owns 40% of the shares. Consider it their right to occupy the most senior positions in the company. So have never been very active in external recruitment, never been very active. So they were not recruiting anyone from outside their family to take up those key roles. They only appointed Mary because they felt they needed a qualified accountant. She was the accountant of that particular company for many years, so they know her, and then therefore they have taken her in that capacity of financial director. They felt they needed a qualified accountant on the board to deal with changes in international IFRS, international financial reporting standards. Several former executive members have been recruited as non-executives immediately after they retired from full-time service. So most of them are from, several former executive members have been recruited as non-executive. So there is a difference between who's an executive director, who's a non-executive director. Of course, I didn't explain to you till now. So as we see that people who were earlier as executive members now have become non-executive members. We will discuss about the difference between these two right now. Immediately after they retired from full-time service. A recent death, however, has reduced the number of non-executive directors to 2. Okay. So after a death also, a recent death, they did not recruit anyone. After a recent death, however, has reduced the number of NEDs, non-executive directors, to 2. So somebody dies who's a non-executive director, someone else has to be appointed, but that also they have not done. These sit alongside an executive board of 7 that, apart from Mary, have been in post for over 10 years. Mary noted that board meetings very rarely contain any significant discussion. Last paragraph we'll discuss little later, but we'll go back to the PPT, okay, and then understand about who are executive directors, who are non-executive directors. We are now looking at the board structure, who would be there in the board of directors. There are executive directors, there are non-executive directors. See, after this image about what the board structure, who has executive directors, non-executive directors, two-tier board has management board and supervisory board. Okay. The management board is responsible for managing the affairs of the company on a day-to-day basis. The CEO coordinates the activities. Then upper tier supervisory board supervises the activities. It appoints supervisors and advises members of the management board. They have the strategic oversight. Strategic is overall, when they look at the overall affairs of the company. So that is strategic oversight of the organization. Includes employee representatives, environmental groups, and other stakeholders, management representatives, who are these NEDs are not considered to be independent NEDs. The chairman coordinates the work. Members are elected by shareholders at the annual general meeting and receives information and reports from the management board. That is the role of the supervisory board. If there is a two-tier board, there are advantages and disadvantages. Now let's come to the who are the non-executive directors, because there's something to discuss about the NEDs. The number has come down to only 2 executive directors. All of them are from their family members only. How do we differentiate between executive directors and non-executive directors? So, in a board of directors, there are 2 categories of directors. Executive directors are from the same organization. These directors do receive their remuneration from the company. Non-executive directors are not someone from the organization. They are not associated with the organization. They are external entities. They do not receive their regular remuneration from the company in the form of salary. So their opinion is independent of that particular situation. Therefore, they will have that fair attitude. But the executive directors, because they are all part of the organization, they may not have that fairness in terms of taking their decisions. Okay. Non-executive directors, their role is strategy role. Okay. Scrutinizing the role, scrutinizing the activities, that role they take up. Okay. When they look into the affairs of that, they have to give their opinion, because all of them meet during the annual general meetings to discuss the affairs of the company. So they cannot have their decisions influenced by the people in the company to talk in favor or against a particular thing. They are completely independent. Okay? They do not receive the remuneration from the company. So they are non-executive directors. They scrutinize, they assess what is the amount of risk that is present in the company, and they take up the role of empathizing or understanding the situation with the people. Okay, that is their role. So what is the advantage of having a non-executive director on the board? See, they do not come under the they are not subject to receiving favors from the company. So definitely they will have an independent view. They will talk about what is appropriate, what is right. Okay, that's the role of an non-executive director. Having them on the board, what is the advantage of having them on the board? See, they would monitor the activities with an independent review. Non-executive directors are usually taken from diversified fields. They are all not from the same expertized area, but different from different expertized areas. These people are taken to constitute the board. So they come with their set of expertise to give their opinion. They carry a perception about what is appropriate or what is not. are able to communicate well with the people in the organization, communication skills, they would be able to communicate with others, and they have their own discipline in terms of, I mean, to carry themselves. Okay. What are the disadvantages? The disadvantages of having non-executive directors, see the unity, the quality about them, and to what extent they are ready to take up the responsibility. Okay. But overall, when we look at that, so we understand that having non-executive directors in the board will give them an independent view. They should be someone who's not receiving their regular remuneration from the company. So therefore, they will have definitely an independent view. So that is the point about having NEDs on the board. Okay, they come from diversified fields, so different areas with their expertise knowledge. They contribute their expertise knowledge. They give an expertise view, vote for something, and take a decision about something. So that is the advantage of having NEDs on the board. They communicate well, they have a discipline, etc. Okay. See, what are the reasons for independence of non-executive directors? To provide a detached and objective view of the board decisions, to provide expertise and communicate effectively, independent voice on the board, confidence in, to provide confidence, because it is not that somebody decides something and the rest of them follow, not questioning. That skepticism attitude is not there. Everybody agrees with the others, so that's called as conformity. So let's say if the chairman decides something, the rest of them all agree to that. They do not even look into whether it is really appropriate for the company or not. So that kind of a thing will prevail if all of them are executive members. Someone is a non-executive, will definitely think about questioning that whether it is appropriate, suitable for the company. So there would be a possibility for a discussion, a round of discussion happens, and then what is possible, what is appropriate, what suits for the organization, those things can be looked into. So if such a thing happens, the best possible thing will be selected and rightly it would be implemented. So if there are non-executive directors on the board, there would be, that would provide confidence in corporate governance, to reduce accusations of self-interest in the behavior of executives. So the self-interest part of it comes into picture when the management is subject to receiving their remuneration, their incentives, their rewards from the company. There will be some amount of dysfunctional behavior on their part. What does it mean, dysfunctional behavior? See, when the management is subject to receiving an incentive based on financial performance, there is every possibility that they can manipulate the financial transactions. They can project that their profits are really very attractive so that they can receive a reward from the company. Then, do not be involved in any decisions where they have to take dynamic decisions. Maybe they can be brought under scrutiny. They can become accountable. Responsibility will be assigned to them. So there is every chance that they can avoid such situations about not taking a decision, not being dynamic in the best interest of the company. So they only look at their self-interest. As long as they are not made accountable, responsible to take a decision. They are okay with the present performance. They don't put in any effort to improve the performance of the organization. So that is acting in the self-interest. Now that if there is a non-executive director on the board, because non-executive directors do not receive the rewards or commissions or bonus from the company, they definitely look at what is best for the company, not for their self-interest. Okay, that's another reason about having talking about the independence of NEDs. Then what are the threats to the independence of non-executive directors? If they are there in that position for more than 3 years, material business relationship in last 3 years, if they were employees in the last 5 years, cross directorship in other companies, they are director in this company, in some other company also. Then remuneration from the company besides directors fees, close family ties with directors, significant shareholders, serves on board for more than 9 years. These are threats of non-executive non-executive directors. So here, in case of having executive directors and non-executive directors, is non-executive directors carry an independent view of the scenario in the company. They have that questioning attitude. They do look into what is appropriate for the company. Since they are not receiving the regular reward, commission, or salary from the company, they are not subject to any kind of self interest. They do not look at their interest, but they look at the interest of the organization. That is the advantage of having them. They should not be in that position for a very long time. They should not be salaried employees. See, I mean, what's the threat if it is so? If they are associated with the company for a long time, there is some kind of conformity comes into picture. They feel that whatever the company has or other superiors have decided, the chairman, the CEO have decided, they feel that yes, that would be the best thing. The CEO and the chairman have taken the right decisions. Um, then they stop questioning them. They do not disagree with them. They agree with everything what the superiors decide. That is a danger what we see. If they were previous employees of that particular company, then the threat is all the more, because they were once upon a time loyal employees of the company, receiving their remuneration from the company. They were under the they were subject to being the subordinates of the uh, directors, earlier directors, once upon a time their bosses or employers. Now if they have to be a non-executive director, that previous influence will be there on them. That is one danger, that's one threat which is there. If they are cross directorships, directors in other companies, maybe their decisions can be in favor of the other company, not this company. That's another danger we see. If they have any other kind of personal benefit receiving from the company, that's a threat. If they have close ties with the directors, then they will definitely vouch for the directors. They will not have an independent view. And then if they are significant shareholders, they will think about their benefit as a shareholder, not the benefit of the organization at large. If they serve on board for more than 9 years, these are threats to that. I hope you remember what we have read just till now. Threat is present there, what is identified by Mary. Mary is now the finance director. Once upon a time, she was the regular accountant of the same company. She has noted down certain important aspects. She has noted down that all of them are there from very long time. The directors, the in the board of directors, all of them are continuing in that capacity for a very long time. From among them, she was the youngest one. So She's also she is subject to that aspect of being a once upon a time employee, now become a director. So she's under that. Okay. Her observation talks about that in the executive positions, uh, the chairman or the chief executive are all from Roche family only. See, when non-executive directors, somebody died, also they are not recruiting anyone from outside. They're only looking at taking into that position the past employees of the same company. So where is the independence? That's a threat to the independence. See, once upon Mary also was an employee few years back. Now she's the director. Will she talk anything against the decisions of the chief executive or chairman? That's a big question mark there. Will she raise her voice? Will she oppose any decision taken by the seniors? So, such a thing is prevailing in the company wherein most of them are earlier employees. They are there for a very long time. See, working in a particular group or an organization for a very long time, what happens is they start accepting the decisions of other members, the other group members, other managers, leaders, without a questioning attitude, because they kind of settle down. They feel that since they have done the best possible thing in the past, now also their decisions are the best for the company, and they do not probe into that situation. They do not raise any kind of a question against them. That situation is what is prevailing here in Roshan company. Okay. Then these sit alongside an executive board of 7 that, apart from Mary, have all been in the post for over 10 years. So it should not be, see, for non-executive directors, it is mentioned that they should not continue for more than 3 years. Executive directors are for a very long period of time, more than 10 years. So where is that issue about having good governance in that? Because anything what the executive chairman or the director decides, we see that they tend to accept that very easily. They do not look at any other possibility of affairs happening with that. So that's one thing. Mary noted that board meetings very rarely contain any significant discussion of strategy. That is the first aspect. Very rarely contain any kind of a discussion happening. So something is decided is blindly followed. Any significant discussion of strategy, and never involve any debate or disagreement. Never involve. When she asked why this was, she was told that the directors had all known each other for so long that they knew how each other thought. All of the other directors came from similar backgrounds. She was told. See here, one more aspect, they have to come from diversified areas. So they bring with them their expertise knowledge. But here we see that all of the other directors came from similar backgrounds. She was told, and had worked for the company for so long that they all knew what was best for the company in any given situation. Threat of conformity. They do not question, discuss, debate, disagree, but whatever the senior management decides, they kind of approve it. Mary observed that notes on strategy were not presented at board meetings, and she asked Timothy Roche whether an existing board was fully equipped to formulate strategy in the changing world. So she has her own doubts whether the board was fully equipped to formulate strategy in the changing world of retailing, and whether a nominations committee. What is a nomination committee? Tomorrow I'll explain. Today it's almost time. So today I will not explain, but what is a nomination committee? We will be looking into that, whether a nomination committee would help address weaknesses. She did not receive a reply. Timothy Roche has subsequently approached you. Now, who are you? You are an external consultant. You are an external consultant to see if there are any weaknesses in the current governance structures of Roche and Company. He also wanted your views on the role of usefulness of a nomination committee. So tomorrow I'll explain what is a nominations committee and see how this question can be answered. Okay, this is a case study for 21 marks. So out of that, 3 marks are given for professional skills, 18 marks are given for the answer. What 3 marks are given? This is for the skill of skepticism skill. Okay. We'll wind up the session here. I hope you will remember whatever was discussed as part of this case study. After that, we will discuss about the nomination committee and how to write a report. Report style also we'll discuss, and exhibiting the skepticism skills. How do we present the answer to score maximum marks? So that's what we will see in tomorrow's class. Is that clear? Any doubts? Any one of you has any doubts? Okay, so we'll complete that as soon as we join tomorrow. We'll look into how to present the answer for this particular case. For that, I will also have to explain nominations committee, and then we'll proceed further with the other topics. Of course, here the section what we are doing now is on a little dry note only. It is on that side only, but we need to learn that. We need to remember that. So that's why I started trying to explain that with the case study. Okay, so other topics, they seem to be little interesting only. Then we can do that in the following class. Okay, let's wind up the session. Good day.